The analysis shows China's economy having a lackluster month with revenue, profit, hiring, and wages all slowing down from a year ago.
The Chinese economy is headed down for much more of a slowdown than we have today.
There's a saying that when the United States sneezes, the rest of the world catches a cold. But what happens when China feels sick? As the second biggest economy on the planet, with over 1.4 billion people, China is in a serious slump right now. Slow economic growth, high youth unemployment, and a troubled real estate market. In September 2023, the chairman of Evergrande, one of China's major real estate developers deeply in debt, was placed under police watch, and the company's shares were pulled from the stock market. The chairman was fined $6.6 million in March 2024 and barred from the securities market for life. While all this creates a big problem for the Chinese government, the question is, how much does it really affect the rest of the world? We'll get into that, but if you enjoy our content, don't forget to like this video. If you haven't already done so, please subscribe to our channel. For the past few months, we've seen that China's booming economy has slowed down, and some people think that it may even miss its growth target this year. Any hopes of a strong recovery after the pandemic have been dashed. But what exactly went wrong with the world's second largest economy? Is there still a chance for improvement? What could the global impacts be? And does this situation make China a risky place to invest? Or could it actually offer an opportunity to buy undervalued assets? There are several reasons behind China's economic slowdown, but we'll focus on just 4, starting with the property market. The Chinese real estate sector was so big that it was compared to the overall economy. What's important to know here is that this included all real estate-related activities, not just construction. It also covered industries like cement production, which supports construction. The Chinese economy was tied to this single sector, and that kind of concentration often leads to trouble. If we compare it to another country that faced a similar situation, Spain comes to mind. Before the global financial crisis, Spain had overinvested in real estate, which eventually led to a market correction and a massive contraction of its economy. In the past, many people argued that China wasn't like Spain. With its more centralized economy, they believed the Chinese government would step in and fix any issues before they got out of hand. However, despite the frequent claim that China is different, there were clear signs that it shared similarities with other countries that experienced housing booms, like the rapid rise in housing prices, the size of the construction sector, and growing debt. Indeed, many of China's economic indicators showed that its long-running housing boom had likely reached a dangerous peak, and that's exactly what happened. In the recent report, it was said that China's top 100 developers saw contracted sales of 185.7 billion yuan, $25.8 billion, during the month. A year-on-year decline of more than 60% and a 21% drop on sales in January. If you examine the year-on-year change in property prices, you will see that prices began to fall in early 2022 and haven't bounced back since. In fact, the decline started speeding up, both for newly built homes and those on the secondhand market. Economists from UBS have pointed out that the fundamentals of China's property market, demand and supply, have shifted in recent years. Confidence in the market is low, partly due to slow household income growth, while inventory levels remain high. Destocking, or selling off of existing properties, has been slow, leading to UBS to downgrade its outlook for the real estate sector. The bank now expects new construction to bottom out by mid-2026, which is still a way off. You might wonder why the property market matters so much. Isn't China's manufacturing and services sector strong enough to make up for it? Well, the property market has a strong effect on wealth in China. When property prices fall, people tend to spend less, which has a ripple effect on the broader economy. On top of that, local governments often funded their operations by selling land to developers. With land sales drying up, these governments are now facing revenue shortages, making it harder to manage the debts they built up during the boom. A second related issue is weak domestic demand. One clear sign of this in the macroeconomic data is deflation. While the West has been dealing with high inflation recently, deflation in China signals deeper problems. At first glance, deflation might not seem bad, but it can be a sign of a lack of consumer confidence. When people stop spending, demand for goods and services drops, companies start cutting jobs, unemployment rises, and the economy can spiral downward. This weak demand is also reflected in lower credit usage and fewer imports. For example, if you look at retail sales in China, you'll see that before the pandemic, year-on-year growth was often above 8%, sometimes even in the double digits. But after the pandemic, retail sales have become much more volatile and generally lower. The most recent growth rate was just 2.7%. China's retail sales expanded by 2.1% year-on-year in August 2024, moderating from a 2.7% growth in the prior month and missing market consensus of 2.5%. For instance, a former governor of the People's Bank of China recently spoke out, urging the country to reverse deflationary pressures quickly. It's surprising he voiced his opinion because, according to the Financial Times, authorities last year began quietly urging experts to stop publicly discussing economic issues such as deflation to try and boost market confidence. But just avoiding the topic won't make the problem disappear. So how could the government tackle this issue? One option is fiscal stimulus, though there are some challenges with that approach, which we'll explore. Another tool is monetary stimulus, which the People's Bank of China has already started using. On top of that, current geopolitical tensions are making things more difficult. For example, there's the ongoing trade war with the United States, and regardless of who wins the next presidential election in November, it's likely that these tariffs will stay in place. If President Trump wins, and polls at the time of this video show it's about a 50-50 chance, he's even talked about raising tariffs further. His plan includes a 10% tariff on all imports, and increases on the current tariffs for Chinese goods. These new tariffs would hurt both the US and Chinese economies. In fact, the US would take a hit of about 1.88% of GDP, but the impact on China would likely be even more severe. UBS economists say raising tariffs to 60% could knock 2.5 percentage points off China's GDP growth. That would slash China's growth in half. Half of that drop would come directly from lower exports. Still, if the Chinese government steps in with stimulus or other policy support, they could reduce the overall impact to a 1.5 percentage point. Even so, it would still be a tough blow for China. This mix of issues and a growing mountain of debt could lead to what some economists call a balance sheet recession in China. So let's break down the debt situation. China's total social financing, a term used by the People's Bank of China or PBOC, consists of several components. This includes central government debt, local government debt, from local government financing vehicles or LGFVs, corporate debt, and household debt. These LGFVs were previously fueled by land sales, which are now slowing down. When you add it all up, these debts amount to a staggering 300% of China's GDP. Instead of reducing debt as China had intended before the pandemic, the debt has only increased. So how does all this lead to a balance sheet recession, and what does that even mean? It involves 4 key steps, 2 of which we've already seen. The first step is a drop in asset prices. This has clearly happened in China's housing market, and for those who invested in Chinese stocks, the stock market as well. Second, we have a huge debt burden left over from the boom years, which the Chinese government hasn't yet managed to ease. When these 2 factors combine, the next step in a balance sheet recession occurs, and it's actually a very logical reaction from both consumers and businesses. They start paying down their debt. If the economy is weak, people and businesses worry about losing their homes or going bankrupt, so they focus on paying off debt. The problem is, when they do that, they're not spending money in stores or reinvesting in their businesses, which means less consumption and investment overall. This, in turn, reduces demand, which leads companies to cut jobs, pushing up unemployment. A prime example of this is youth unemployment in China, which was rapidly increasing before the government stopped releasing the data. This starts a downward spiral: weak economic activity, reduced demand, and rising unemployment. The government then has to stimulate the economy to keep things afloat. But because economic activity is low, its revenue falls, forcing it to take on more debt to fill the gap. What happens next is that private debt gradually shifts to public debt, and government debt to GDP starts climbing rapidly. Many expect this to happen in China now. It also happened in Japan, which now has a debt-to-GDP ratio of over 250%. The big issue with a balance sheet recession is that it takes a long time to fix and leads to a prolonged period of slow economic growth. China's current challenge is that it's sitting on a massive debt pile while the economy slows down. The government can't afford to stimulate the economy without adding more debt. but at the same time, it needs to reduce that debt without causing the economy to crash, which is a very tricky situation to navigate, and the effects of this slow growth will ripple across the globe. A study from 2016 sheds light on how a 1% drop in China's GDP can impact the economies of other nations. Unsurprisingly, the hardest hit countries are those that have close trade ties with China. These include smaller nations like Indonesia, Malaysia, the Philippines, and Singapore. But larger economies like Australia, which supplies a lot of raw materials to China, are also affected, as well as some countries in the EU. China is not like Russia in this regard. While Russia's economy has a limited effect on global growth, China is more integral to the world economy. If China experiences weak growth, it will have ripple effects globally. One clear consequence is that commodity prices, especially those heavily bought by China, would likely drop. A good example of this relationship is copper. In the chart from the paper, Chinese GDP is shown in the top panel, while copper prices are in the bottom. When Chinese growth surges, copper prices follow suit. When China's economy slows down, so do copper prices. In fact, many see copper prices as a decent indicator of China's economic health. Recently, copper prices have been falling, signaling concerns about China's growth. But it's not just copper. Other raw materials like oil and iron are also affected by shifts in China's economy. When China's demand slows down, the prices of these commodities tend to weaken, which is a key way in which China's economic performance influences the rest of the world. The good news is that so far, the drop in China's stock market hasn't caused too much volatility globally. Historically, this hasn't always been the case, but for now, the situation seems relatively contained. It might be because not all sectors are struggling. While China may miss its 5% growth target for this year, its growth is still solid compared to developed markets. Plus, not every sector in China is performing poorly. The sectors that the Chinese government has prioritized, such as electric vehicles and renewable energy, are doing particularly well. This is due to both government support and the fact that Chinese companies produce high-quality products in these areas. For example, China now has about 90% of the global market share for solar panels, 67% for mobile phone production, and 60% for wind power equipment. These are all highly successful industries within the Chinese economy, and they might be worth focusing on if you're considering investments in China. The problems facing China's economy, particularly its large debt, will likely take years to resolve. A balance sheet recession like the one China seems to be experiencing cannot be fixed quickly. However, the fact that China can learn from Japan's experience with a similar situation might help it navigate the crisis more effectively.